You're listening to the Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from the Moose on the Loose. Happy Monday. I hope that you had a great weekend. Today, we are going to talk about stocks I would like to add to my portfolio, but I never did. And I'm going to tell you why at the end of this episode. But we're going to talk about 4 companies that I wish I had in my portfolio. Stocks, that you watch, you find interesting, you do some research, but you never pull the trigger, right? In the past, I hold on to pulling the trigger for a while on companies like Visa or Costco, Constellation Software. They sat on my watch list for years before I finally decided to buy some shares. And I mean, for those 3 examples, of course, I'm super happy. Sometimes it's not always that easy. Sometimes you buy and that was wrong as well. But anyways, just wanted to share my thoughts about 4 companies that are on that kind of like watch list forever. And I do have some reasons for not pulling the trigger. So we're going to talk about that too. So the first one on the list, TMX Group, X.to. This one, I talked about it not too long ago on the show. So TMX is actually running the TSX, so it's running the stock exchange in Canada. They have like 50% of their revenue that is recurring. So mostly because they're handling the IPOs, they're selling data analytics as well to financial firms. They are clearing all trades, so they are essential, right? If you want to invest in Canada, buying Canadian equities, well, chances are you're going to deal with TMX, right? It's kind of like a monopoly in a sense where it's really hard to buy stocks on the Toronto Stock Exchange without paying any fees or being involved with TMX. The company, what I like about it is it grows by organic growth and also by acquisition. So on the organic side, of course, the more there is volume, the more there are investors, the highest level of money coming, like capital coming into the market, well, they're making more money. So as the stock market over the long run keeps on growing, well, they have that natural growth, and they also grow by acquisition as well, acquiring like new technologies, like new specific segments and stuff, which led to an amazing dividend triangle, actually, where you have over the past 5 years, annualized growth rate for revenue at 13%, the earnings per share at 14.5, showing like better margin, and a dividend increase rate of 8% per year over the past 5 years. So very, very stable and strong dividend triangle. Nothing is perfect, so a piece of warning here. The revenue and the earnings have been slowing down as of late over the past 2 years. So the stock price has not decreased, but revenue and earnings are not growing at the same double-digit pace all the time. So there are some slowdowns here there. You have to be careful. That is maybe one note of warning on this one. Moving on to another one that has been flashing red light, actually should be bright green or something like that on my radar, Dollarama. Dollarama, big retail leader in Canada. It's a beast when everything goes well, and it's also a beast during recession. This is one thing that I love about this company is no matter what's happening with the economy, they're going to sell stuff. And actually, when it's tougher and consumers are closer to their budget, they're actually going to go more to Dollarama. So it's even better, right? I like the fact that they also try to expand outside Canada. They have now a 60% stake in $2 City, which is great because it opens the door to Central America, kind of counterintuitive, right? When you're thinking about growing, but definitely a good place to start shops. And they now have an offer on the table to acquire an Australian retailer, the Reject Shop. So not a huge acquisition, that would not necessarily change the needle. Similar to Dollar City, I think it's like less than 10% of their revenue, but still could be interesting for the future. So another good way to grow. Their playbook is super simple. They have like small stores full of stuff. 60% of the goods they sell are private labels, which leads to higher margin. So very, very solid company. I couldn't believe they could continue to grow at this pace in Canada, but they actually can. They show a nearly perfect dividend triangle with 10% revenue growth, 16.5% earnings per share growth over the past 5 years. And that's analyzed growth rate. That's not like 16 for the past 5 years. That's like 16 after 16 after 16. This is just crazy. They show better margin, of course, and dividend increase of 12% per year. Kinda crazy. The warning here, I would say, well, acquisition, like, we have seen how it turned out into the US. Not too long ago, we had like a dollar store that sold an acquisition. They paid, like, I think it was like 9 billion, and they sold it for 1. So not always easy. The debt is increasing because they're opening new stores all the time. Yet the metrics are like solid behind it. And I would say the stock is never on sale. So whenever you're ready to jump in this one, you have to bite the bullet and say hallelujah. Intact Financial, another one, IFC.TO. I just did an episode on the Moose last week, so you can listen to it. Leader in Canada, expansion plans in the US and the UK. They're already there. They have like a lot of data, so they do better underwriting for their premiums. They focus on online insurance, plus a little bit of like artificial intelligence there. So it's highly scalable. Revenue up 16%, earnings per share up 19.5%, dividends almost at 10%, 2 decades of dividend growth. A lot of good things to love about this one, but again, saw some small warnings. Natural catastrophe, of course. There's always a guidance for that, so they project some expected losses, but it could be higher. And I would say growth going forward, revenue and earnings have slowed down since 2022, so got to be careful about this part. As you can see, Moose, those 3 companies, TMX, Dollarama, and Intact Financial, they all have 2 things in common. They have low yield and they have a high dividend growth perspective. The reason why I love them so much can be found at moosemarkets.com/income. So you can download the dividend income for life guide. And in this guide, I give you a complete portfolio filled with those low yield, high growth stocks with robust dividend triangle, incredibly solid business model. And I also show you that they're actually safer than investing in high yielding stocks, and I explain why in that guide. So you can download it at moosemarkets.com/income. So to finish the episode, I just thought of like sending one, talking about one that is on the US market, usually cover just Canadian stocks here, but wanted really to highlight this one because it's on my radar since 2016. That's crazy. Broadcom, ticker AVGO, major semiconductor and software maker. They are known for their RF filters that improves connections in cell phones, and smartphones. So like Apple, Google as clients, like small players. They are involved into so many different types of semiconductors that they have growth in networking, in cloud computing, artificial intelligence, data center, name it. They are everywhere. They grow organically, they grow by acquisition, and they're known to have like a perfect playbook where they have a lot of expertise acquiring a bunch of businesses and cross-selling products and clients together. Is just beautiful. Revenue over the past 5 years, growth, annualized compound growth at 18%, earnings per share at 14, dividend at 15, and the cash flow from operation is kind of like a direct line towards the sky. It is just crazy. Big warning, of course, huge drop as of late. Driven by maybe that AI will not need that many semiconductors, that many data centers. Maybe they're going to find more efficient way, because right now we know it requires a lot of computing power. With DeepSeek coming up, shows that you can do a similar thing, but with less less energy, smaller technology. So we'll see how it goes. Of course, recession, tariff war, all the tech stocks are getting beaten up right now. So that's why the stock price is going sideways big time. To end the show, why I'm not pulling the trigger on those? Well, for TMX and IFC, so for TMX Group and Intact Financial, the reason is simple. I already have a very large exposure to financial stocks. I did not want to add more on this one already. So whenever I sell something, maybe I'm going to be tempted. But at this point, that's the only reason why. For Dollarama, for a long time, I was skeptical to see them continue grow organically in Canada by opening new stores. They're definitely showing me that I was wrong on this one. And for Broadcom, actually, for a long while, back in 2017, I made a decision of investing in Texas Instrument instead of Broadcom. That wasn't like a bad move, but that wasn't the perfect one either. So just too much exposure to the technology sector at one point. Right now, I'm a little bit lower on that, so maybe I'm going to be ready to pull the trigger on Broadcom. I mean, we'll see. All right, Moose, do not forget to download the Dividend Income for Life guide to understand more about my strategy and to get a complete playbook of how to invest in low yield, high growth stocks at moosemarkets.com/income. And again, we're going to talk tomorrow. And until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose on the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.